Hello everybody, this is AK. I'm back. So a friend asked me why did I say buying more shares of OCBC at under $15 per share recently, like I did, means getting a normalized dividend yield of about 5.5%. Which of course didn't take into account the special dividend that OCBC is paying. I mean, if we take into account the special dividend that OCBC is paying, then the dividend yield would go up to maybe 6.7%. Not too sure about the number exactly, but it'll be much higher than 5.5%. All right. So the thing is, special dividend, well, it could continue next year because like I said, all our banks have a lot of excess capital, very high CET1 ratio, but there's no certainty that there'll be special dividend next year or the year after that, right? Especially now with all these crazy tariffs Donald Trump is imposing on the rest of the world, which would probably lead to an economic slowdown globally. And if we remember, out of the three banks, OCBC, UOB, and DBS, only DBS said that they plan to have capital returns to shareholders until 2027. Right, so basically a 3-year plan, 2025, 2026, and 2027, to return capital, excess capital to shareholders in the form of share buybacks and also special dividend. Only DBS gave that guidance. OCBC and UOB did not. OCBC and UOB said additional capital return was only for 2025. Right, so special dividends only for 2025. They did not commit to more special dividends in 2026 or 2027. Right, so, and if you remember, DBS, even though they gave forward guidance for 3 years, they also say that this will only happen all else being equal, which means if there are some circumstances unforeseen, throws a spanner in the works, there might not be special dividends next year either. So the thing is, I think we have to temper our expectations for special dividends from all three banks next year. Very likely it's not going to happen if this Donald Trump crazy tariffs stay in place. Right, if it doesn't dial back, if it does, I think we're in for some challenging times ahead. Having said that, our banks, local banks, OCBC, UOB, and DBS, they are very well capitalized, right? But they can be more cautious. No, nothing wrong with that. There's they want to err on the side of caution. And if they stop returning additional capital, right, stop returning excess capital to shareholders next year, this will basically give our banks more capital cushioning, right? So there'll be a thicker cushion. I mean, they already have very strong balance sheets, very strong provisioning cover, right? So they've made provision for bad loans and all that. So very strong balance sheet, ample provisions. If they should stop the return of excess capital to shareholders, basically it just means that we have our banks have a thicker capital cushion. And the CET1 ratio will probably stay well above 15%, right, all the way to 2027, right, the next 3 years. And I mean, it's way above what is required by regulation, but Singapore banks have the Singapore trait of being kiasu, kiasu, and in this case, it's really kiasi. This will make sure our banks stay afloat, right? And that means that we as shareholders have peace of mind, and we don't have to fear them going kaput, right? So because of this, we can invest in our local banks with a greater sense of confidence, right? With greater confidence and peace of mind. Basically, I think of DBS, OCBC, and UOB as safe haven investments in Singapore. And if they should suspend the return of excess capital in the next 2 years, DBS, right? Basically, it will just make the safe haven status even stronger. And if prices should decline, if OCBC goes to like $14, and if UOB goes down to like $30, and if DBS goes down to something like $35, I think I'll be very tempted to pick up more shares in our local banks. I like the idea of investing in very strong entities, right? Strong balance sheets, and very safe and still very profitable and very well run. Our local banks are very well prepared to face the more challenging times ahead. They are probably better prepared for this crisis than they ever were for past crises. When their share prices saw big plunges, very deep plunges, because they were not as well prepared. So this time round, they are very well prepared. Their non-performing loan provisions, for example, is way above 100%, right? Provisioning cover is way above 100%. Even though asset quality, you expect that to worsen, we have full confidence in our local bank. We should, because they have made provisions way above what is probably required, right? And if we expect tougher times, and we are not well prepared, then we should be worried. So what kind of businesses should we be worried about? We should be worried about businesses which are highly leveraged, very weak balance sheets, right? During tough times, what happens is these businesses with weak balance sheets, usually they stay afloat because the business is still chugging along and cash flow is still healthy, right? But during bad times, when cash flow dries up, because business slows to a trickle, right? And this is what we expect the new environment to be with all the tariffs. Then when cash flow dries up and then they have weak balance sheet, that's when these businesses will go kaput. But not the case with OCBC, UOB, and DBS, right? They will keep chugging along, and I won't say I look forward to further price weaknesses, but if Mr. Market should go into depression and offer me lower prices, I'll buy more. Right, so that's all for this video. If AK can talk to himself, so can you. Bye-bye.